Okay, the next problem on our list is E77. E77 is similar to E75. It asks us to do similar requirements, similar type exercise, but it gives us slightly more calculations that we have to do. The first requirement says calculate the number and cost of goods available for sale. Same requirement that we had in E75, except that in this point we actually have to crossfoot or multiply out the numbers, right? In E75 they actually gave us the totals. In this problem we have to take the number of units times the price per unit to get us our cost. So they wanted both. They wanted the units and the cost, right? So units are given to us. We can simply add these up. Beginning inventory plus net purchases is going to give you cost of goods available for sale, right? Notice in the starting point here for requirement number 3, we're going to start with cost of goods available for sale. In E75, I actually show you how to get to cost of goods available for sale, but from this point on, we're just going to start as this is our starting point, because this is going to be the same no matter what method you use. LIFO, weighted average, FIFO, doesn't matter. But to get the total units, you add up beginning inventory plus the purchases. That gives you units. You multiply these out, and that gives you total cost, right? So the total cost of goods available for sale that we have is 164,500 or 17,500 units. Requirement number 2 asks us to calculate the amount of ending inventory, okay? So they give us our sales. They tell us that total sales is going to be 12,000. They broke it out in sales 1 and 2. I've broken it out in sales 1 and 2 as well for purposes of explanation. So in this problem, we're doing the periodic inventory method. We're assuming that it's just periodic as opposed to perpetual inventory method. Perpetual inventory method tracks every single time a sale takes place, removes it from inventory, and calculates cost of goods sold, right? Well, if you're using perpetual inventory system, these methods might change in their actual results as opposed to periodic inventory method. FIFO will never change because the first thing in is the first thing out, and it doesn't matter if it's perpetual or periodic, you can only sell what you have, okay? So FIFO will never change whether or not you're doing periodic or perpetual inventory system. But LIFO and weighted average could change. It really depends on the amount that you sell and the amount of inventory that you have. But LIFO and weighted average could definitely change, right? In fact, for weighted average, we changed the name to moving average if you're doing a perpetual inventory system. So I've broken out the sales for that purposes for explanation. If you combine them, then that's fine, because later on down here, you notice that we take sales number 1, sales number 2, and combine that gets you cost of goods sold, okay? So requirement number 2 and all that explanation, requirement number 2 just wants us to calculate the ending inventory in terms of units, right? We wouldn't do cost because cost is going to be different depending on which method that we use. So in terms of units, we start with 17,500 that we can sell. We sell 12,000. That gives us 5,500 as ending inventory. Requirement number 3 says calculate the cost of ending inventory and the cost of goods sold under the FIFO, LIFO, and weighted average cost. Okay, so I started off with the cost of goods that we can sell. So here's the amount that we can sell, 164,500. Sale number 1. Sale number 1 says that we sold 4,000 units, right? Well, FIFO says first in, first out, right? So what was our first units that we could sell? Beginning inventory, 3,000, right? 3,000 at 8, those are the first ones that we can sell. But does that meet the 4,000 requirement? No, we're still 1,000 short, right? So we have to go to the next level down and take 1,000 at $9, right? So 1,000 at $9, 3,000 at $8 should give us a total amount here of 33,000. That's sale number 1. Sale number 2 says we sell 8,000, right? So we go down to our next level. Since we took 1,000 here, we still have 8,500 left, right? So we can suffice that 8,000 sale, take 8,000 times the 9, and that should give us 72,000. Okay. Add those total up and you get 105,000 for cost of goods sold, and ending inventory should be 59,500. So that's our first requirement, right? In terms of requirement number 3 for FIFO. Let's go on to LIFO. LIFO indicates that, again, we have 164,000 for cost of goods available for sale. We have the 2 sales that take place, but in this instance, it's last in are the first ones to be sold, right? So instead, we work our way from the bottom up, right? First sale is 4,000 units. We had a latest purchase of 5,000, so we can use all 4,000 here at $11. 4,000 at $11 is 44,000. Next sale that takes place, we sell 8,000 units, right? So we still have 1,000 at $11, so I've written 1,000 here at $11, right? And then that uses up all of this purchase level. Going to the next level, we still need 7,000 more. So we take our 7,000 at $9 a unit, right? Should give us a total amount here of 74,000. Add these two up, you should get 118,000 for cost of goods sold, right? Subtract from cost of goods available for sale, ending inventory should be 46,500. Moving on to weighted average. Weighted average, again, starts at the same starting point, but we have one small calculation we have to do before we can actually get cost of goods sold, right? We have to determine our amount per unit. Okay, so in order to get that, we take the 164,000 that we had here for cost that was available for sale, and take 17,500 and divide it into that amount, right? Should give us 9.4 per unit. If you take 164.5 divided by 17.5, you should get 9.4 per unit. Since combined we sold 12,000 units, right? Our total cost of goods sold is then 112,800, and subtract from the 164,500 should give us 51,700. So that's our ending inventory here. The next part, requirement 4. Requirement 4 asks us to actually look at the income statement. So it gives us a bit more information, right? It tells us that it first wants us to calculate total sales. Well, from these sales, it tells us that on April 15th, our first sale, we sold $29 per unit, right, in 4,000 units. And then our second sale was on October 31st, we sold 8,000 units at $31. When we multiplied those two out, we get 364,000. This is our actual sales. Notice that we're starting with sales because it's asking us to look at the income statement, right? Revenue minus expenses equals net income, so we start with sales, which are revenue, right? It's going to be the same no matter which method that you use. Remember that the methods that we're using calculate the cost of goods sold, not the price of goods sold, right? So, 364,000 sales price, sales price, sales price. Next we have to plug in the cost of goods sold. So, pull this from the calculations that we've already done. 105,000 here for FIFO. And 118,000 for LIFO. And then weighted average 112,800. Subtract those out and that gives us gross profit. Remember, gross profit, sales minus cost of goods sold. Then it tells us operating expenses are 250,000. Doesn't matter which method that we use. This is just part of the information given in the problem. Plug those numbers in. Should give us income from operations at 9,000. 4,000 as a loss, and 1,200. The next part of the problem says compare the income from the operations and the ending inventory amounts and explain the differences. Well, when we look at this, notice that this has been a period of rising prices. How can we tell that? Well, first, our costs increased from 8 to 9 to 11, right? So the prices are increasing. As well as if you look back at the problem, it says our first sale in April 15th was for $29 per unit. We then take the second sale on October 31st for $31 per unit. Again, period of rising prices. We know from working on M75 that in a period of rising prices, right, FIFO is going to produce the highest amount of income. Why? Because the lowest amount were the first goods that came in, right? And those were the first goods sold under FIFO. First in, first out, which means cost of goods sold is lower, right? Which means income is higher, right? Notice that LIFO produces the least amount of income, right? Again, because the highest prices were the last ones to go out. Last in, first out, right? So those are the highest costs, meaning those are the highest cost of goods sold, meaning this is the lowest amount of income, right? And the weighted average, just as it describes to be, is a mixture in between the amounts, right? You could get the actual differences between all the methods by simply comparing the differences in ending inventory and the differences in income, okay? The next requirement asks us which inventory costing method may be preferred by this company for income tax purposes. Well, obviously you can see that the lowest amount of income that we have here is going to be LIFO, and that makes sense in a period of rising prices. LIFO is going to produce the least amount of income, therefore the least amount of taxes. Okay? Study these problems because E77 and E75, great representations of something that you might have to do on the exam. If you have any questions, please feel free to email me or stop by my office. Thanks.